Okay, before we jump into the nuts and bolts of accounting, let's review some basic background information. Most of this is pretty general information, easy to understand, and I don't think you'll have any troubles with this. So the first step is always to define accounting. There's always a lot of questions about what exactly accounting is, and your book has this definition. It's a pretty standard definition. It says accounting is the process of recognizing, measuring, and recording and reporting information about a business transaction to stakeholders outside of the business. So in effect, accountants or accounting is the scorekeeper of the business. They keep track of what's going on in the business so that we can make changes to our game plan as we go along. The definition of a business is that it's a legal organization which attempts to create value by exchanging products with customers for money. An organization must have three elements to be called a business. So it's legal, it's empowered by the state to operate. It must exchange a product, often referred to as either a good or service for money or some sort of money substitute. The goods are physical items that we can touch and feel. Goods are tangible. Examples of those would be foods, cars, clothing. Services are activities that we know exist but we cannot touch and feel. Services are what we call intangible. Again, there's no physical touch there. Examples of those would be medical services, car repairs, and education. But providing products is not sufficient for a business to be called a business. Someone must buy these products for money or money substitutes, which, for example, would be a promise to pay later, an IOU. So who buys the products for money or money substitutes? The answer is going to be customers. To succeed, businesses must create an exchange with a customer, and the exchange is called a sale. Businesses create value, and customers get value from benefits or products. However, other stakeholders in the business should also receive value. Owners get value from profits a business earns, employees get value from their wages, lenders get value from the interest they charge, and so on and so forth. Now back to the general concept of what value is, and the value of an item is what someone is willing to pay for it, and therefore value depends on what the owner of the item expects to receive, when the owner expects to receive it, and how certain the owner is about what they'll receive and when they'll receive it. Businesses are very much the same, that businesses try to create value by exchanging a product with a customer, and businesses buy or make products at one value, which is what we call cost, and try to sell those products to their customers at a higher value, which is what we refer to as revenue. This exchange creates a profit, which is net benefit to the business. Making a profit is very important for profit businesses and drives the value of business. Accountants are responsible for measuring revenue, costs, and profits. And then in addition to the amount of profit business people also worry about when they make a profit are the risk that they take to generate that profit. So time does impact the value of an item, as we'll see throughout the book. Accountants worry about when to recognize business transactions such as revenue, cost, and profit. So the goal for business is to create value for owners, and owners expect a profit that compensates them for the use of their money over time and for the risk that they're going to assume. If the business doesn't create value, owners will not provide the money needed to operate the business, and without the business, customers, suppliers, employees, and society will not receive the value that they seek. A business must create value for its owners. However, to do so, owners must appreciate the other stakeholders who must also receive value. A business has many stakeholders or people and organizations that are affected by a business. And these stakeholders include customers, employees, suppliers, regulators, society, lenders, and owners. And all stakeholders should believe that they are receiving value from the business. In other words, each stakeholder in a business gives and receives value through an exchange. And ideally, each stakeholder believes that the value they receive exceeds the value they give up. An employee gives a business their labor for a paycheck. A supplier sells products to a business, ideally at a profit. And a customer buys a product from a business at a price. Society and regulators appointed by society benefit from a business through jobs, taxes, and hopefully a better quality of life. To operate, businesses need to acquire money and use that money to make a profit. A firm acquires money by borrowing money from lenders, which is what we call liabilities. This is going to be a new term for many of you, a liability. It's something that we owe. And then getting owners to put in their own money is what we call owners or stockholders' equity or shareholders' equity in exchange for ownership. And there's shareholders' equity. I more commonly refer to it as stockholders' equity, but again, that's what owners get in exchange for their putting money into the business. They get ownership in the business. We call equity. And often people will say that the owners invested their money in the business. A liability is a financial claim or debt that the owner to the business, that the business owes to a party that's not an owner of the business. Owner's equity is money provided to the business by owners, either through an initial investment or through the retention of profit. A business then uses the money to acquire assets and to hire people, and an asset is an economic resource that a business owns and can use to operate the business. Assets include cash, inventory, and buildings. So if you think about it, something that a business owns, we call that an asset. Business also hires people called employees to operate the business for a period of time. But employees, though, are not assets. The company doesn't own them, even though sometimes we tend to think that. That's not the way it actually works. So the business operates in hope of generating a profit where revenue is greater than expenses. Revenue is going to be money or other value received that a business earns from the sale of goods or services. Expenses, which we often refer to as costs, are money or value surrendered from operating the business. It's part of operating the business is making sure lenders are paid interest, and interest is the expense of using borrowed money over a period of time. That's also will fall under this category. And then after paying interest and all the other expenses, the owners of the business gets what remains and what we refer to as profit or net income. Net income is going to be our revenues minus our expenses. And then the question that owners must ask is whether the net income is worth the time and risk involved. Some owners have many alternative uses for their money, and they, like everyone else, seek the greatest value or return on their money. Just to reiterate, money does have a cost, and businesses can get money by borrowing it, or they can provide it themselves. So if they borrow the money, they must pay the lender rent on the money, which we call interest. It must also return the borrowed money at an agreed upon time in the future. You don't get to keep it forever. However, owners' money also has a cost. Owners are not going to provide money without expecting to receive a benefit or net income over time. Why should they just give up their money for free? So why would an owner put money in a business for no net income when they could deposit their money in a bank and earn interest? Never forget, money, whether borrowed or provided by owners, has a cost. And the cost of money is dependent on many things, but above all else, it's a function of the risk of the lender or that the owner is taking. Remember, great risk must be compensated by great return.